Someone finally invested their first $2,000 this spring. 6 weeks later, the market dropped and their app showed $1,760. That same night, they sold everything. Here is what nobody told them. The recovery started 9 days later, and by selling, they locked in a loss the market was already fixing. That one tap cost them more than the drop ever could. Welcome to FinFinance. In the next 10 minutes, you will see the 3 mistakes almost every beginner makes in their first year of investing, ranked from least to most expensive, and the exact fix for each one. Subscribe and tap the bell, because the last mistake is the one quietly cutting people's retirement in half. Let us get into it. Before we get to mistake number 1, you need to see one number. The most recent Dalbar Investor Behavior Report tracked how real investors actually perform against the market. The average equity investor has now underperformed the market for 15 straight years. 15 years. Not because the market failed them, the market did its job the entire time. They lost to their own behavior. The exact 3 behaviors we are about to break down. And here's the good news. Every one of these mistakes has a fix you can apply this week, starting with the one that feels the smartest. Mistake number 1, starting with individual stocks. This one feels like real investing. Your feed is full of people posting screenshots of one stock that doubled. The apps celebrate every trade with confetti, so your first move feels obvious. Find the next big winner and buy it. Think about the claw machine at the mall. Every so often, you watch someone pull out a giant plush toy and the whole crowd sees it. What you never see is the 50 people before them who walked away with nothing. The machine is designed so you only remember the winner. Stock picking works exactly the same way. You see the one win on social media, you never see the losses. Now here's what the actual data says, and it shocked even professional investors. A landmark study from Arizona State University looked at every US stock since 1926. 4 out of every 7 stocks earned less over their lifetime than boring, ultra-safe treasury bills. That means most individual stocks lose to the safest investment the government offers. Read that again, and it gets more extreme. Just 4% of all companies created the entire net gain of the US stock market. The other 96% combined added nothing. And inside that winning group, the concentration gets even crazier. Just 86 companies out of more than 26,000 produced half of all the wealth the stock market has ever created. 86. Your odds of picking one of those on your first try are not investing odds. They are lottery odds, dressed up in a suit. So when you pick one stock, you are betting your first savings on finding a needle in a haystack, while the haystack itself was the prize all along. Here's the fix. Your first dollars go into a broad index fund. An index fund is a single investment that automatically buys hundreds of companies at once. Apple, Amazon, Microsoft, through apps like Fidelity or Charles Schwab. Instead of hunting the winning 4%, you simply own it. You can do this tonight in about 4 minutes. And if picking stocks genuinely excites you, keep it, but cap it at 10% of your investing money. That is your entertainment budget. The index fund is your wealth. That mistake costs you performance. The next mistake costs you time. And time is the one thing you can never buy back. Mistake number 2, waiting for the perfect moment to start. This one sounds responsible. The market is at an all-time high, so you tell yourself you will wait for the dip. Your money sits in cash, ready, watching. Weeks pass, then months. It is like refusing to leave your house until every traffic light on the route is green at the same time. You are not being careful. You are just never leaving. And every day you wait, the destination moves further away. Here is what waiting actually costs, from research most beginners never see. If you missed just the 10 best days in the market over the past 30 years, your total returns would have been cut in half. Half. 10 days out of roughly 7,500 trading days. Miss the best 30 days, and current Wells Fargo research shows your average return drops from 8.4% a year to 2.1%, below inflation. You would have taken all the risk and kept none of the reward. But here is the twist that breaks the waiting strategy completely. 76% of those best days happen during bear markets or right at the start of a recovery. The best days hide inside the scariest weeks, so the person waiting for calm is guaranteed to be standing outside exactly when the biggest gains arrive. Nobody gets a notification when the best day is about to happen. Not you, not the professionals, nobody. And if you think perfect timing would be worth the wait, researchers at Charles Schwab tested exactly that. They compared an investor with impossibly perfect timing, catching the exact bottom every single year, against someone who simply invested immediately, every year, no matter the price. The perfect timer barely won. Then they ran the test across 80 different 20-year periods going back almost a century. In 70 of those 80 periods, the ranking never changed. Being early beats being clever, almost every single time. Here is the fix, and it removes the timing decision from your life forever. It is called dollar cost averaging, a fixed amount invested automatically on the same date every month. $50, $100, whatever fits your budget. When prices are high, your money buys less. When prices drop, the same money buys more. You stop guessing, and you catch every recovery automatically because you never left. Set the automatic transfer tonight. One decision, made once, that never needs your courage again. Quick question before the most expensive mistake of all. Type a 1 in the comments if you have ever kept money in cash waiting for the perfect dip. Type a 2 if you have ever sold during a drop. Be honest, I am reading every single reply.
Mistake number 3, and this is the one from the start of the video.
Selling when the market drops. Remember the person with $2,000 that became $1,760? Selling felt like the smart move. It felt like protecting what was left. That is exactly what makes this mistake so dangerous. It never feels like a mistake while you are making it. It is like quitting the gym in week 3 because your muscles are sore. The soreness was never the sign it was failing. The soreness was the sign it was working. Everyone who quits at that moment pays the full price of the membership and walks away with none of the results. Market drops are the soreness. They are the price of the returns, not the reason to leave. Now watch what this behavior costs in real numbers. In the most recent Dow Bar report, the market returned just over 25% in a single year. The average equity investor earned 16.5%. Same market, same year. The gap came almost entirely from people moving their money at the wrong moments. And over 20 years, that gap becomes unforgivable. $100,000 left alone in the market grew to about $717,000. The average investor, jumping in and out, turned the same $100,000 into about $345,000. That is $371,000 gone. That is a fully paid off house handed back. Gone. Not lost to a crash, not lost to a scam, lost to their own thumb, tapping sell at the worst possible moments. And here is the cruelest part of the cycle. History shows the market's best days almost always arrive right after the worst ones. So the person who sells during the drop is not just locking in a loss. They are standing outside the door at the exact moment it opens. Then, months later, when everything feels safe again, they buy back in at higher prices. Sell low, buy high. The exact opposite of the one rule everyone knows. And unless something breaks the pattern, that cycle quietly repeats every few years for the rest of their investing life.
Here is what that actually looks like across a decade. Someone starts investing at 25. The first drop hits at 27. They sell. They wait 8 months for things to feel safe again. They buy back in higher than where they sold. The next drop hits at 30. Same thing. Sell. Wait. Buy back higher. By 35, they have technically been investing for 10 years, but their money has only actually been in the market for about 6 of those years. 4 years sitting in cash, waiting for calm that always came after the best days already passed. They did not lose to the market, they lost to the calendar. And the brutal truth is that almost nobody connects the dots between the selling and the shortfall, because the loss shows up 30 years later at retirement, not the week they press sell. That delay is what makes this the most invisible and most expensive mistake on this entire list. Here's the fix, and it has 2 parts. Part 1, the 48-hour rule. You never sell within 48 hours of a market drop. No exceptions. Panic has a shelf life, and it is shorter than 48 hours. Write this sentence in your phone notes tonight. I do not sell when the market drops. Read it before you ever touch that sell button. Part 2, remove the trigger. Tonight, open your investing app settings and turn off price notifications. Checking your balance daily is how a normal drop becomes a personal emergency. Your investments are a crock pot, not a frying pan. The less you open the lid, the better the result. Look at the 3 mistakes side by side. Picking stocks cost you the market's performance. Waiting cost you the market's best days. Panic selling cost you half of everything at the finish line. And all 3 have the same root. Trying to be clever with a system that pays you for being consistent instead. So here is your one move tonight. Open your banking app. Set 1 automatic monthly transfer into a broad index fund. Then turn off your investing app's notifications. 2 taps. That single setup quietly protects you from all 3 mistakes at once. No stock picking, no timing, no panic button.
The market has never needed you to be brilliant. It has only ever needed you to stay. Every fortune the stock market has ever built belonged to someone who simply refused to interrupt it. If this video showed you something the apps never will, subscribe to FinFinance and tap the bell. And if you are wondering what order your money should follow before you invest a single dollar, the emergency fund, the employer match, the accounts that grow tax-free, we broke down the exact 6-step ladder in our video on how to start investing from $0. It is on your screen right now. We will see you there.